Our next speaker is Dr. Samih Azar. Dr. Azar is a full professor of business administration and economics at Haigazian University. He holds a BS degree in biochemistry and an MBA, both from the American University of Beirut. He also holds master's degree and a PhD in economics with a specialty in business and financial economics, both from the Claremont Graduate University, California, USA. Dr. Azar has taught at Claremont McKenna College, AUB, LAU, St. Joseph University, and USEC. He is affiliated with Haigazian University since 1997. Dr. Azar's presentation will be on oil as an investment asset. Dr. Azar, the stage is yours.
Good afternoon. My contribution to this conference would be rather technical, but it will be short. So bear with me. The purpose of this presentation is to study the attractiveness of oil as an investment asset. Modern finance theory postulates that an asset has value from its contribution to portfolio analysis. I create a portfolio made up of 5 assets, and I calculate the returns and variance-covariance matrices of these assets and appropriate manipulations to get the minimum variance portfolio. The 5 investment that I chose in the portfolio are an investment in oil, an investment in gold, an investment in the US S&P 500, an investment in the euro foreign exchange rate, and an investment in a deposit in a Lebanese bank at a bank, in Lebanese pounds. Annual average returns of these 5 investments from 1987 to 2015 are as follows. Oil, approximately 12%, gold, 12.5%, S&P 500, 16.5%, euro, 8.9%, and a deposit in Lebanese pounds, 10.5%. I'm going to assume that investors prefer to be concerned with real, which means inflation-adjusted returns. This is a formula for the computation of the real adjusted return. After doing all the calculation, I got the following results. The average optimal oil share should be 6.83% of total portfolio value. Gold should have 44%, S&P 500 should have 41%, the euro should be shorted or sold short with 5%, and a deposit in Lebanese pound should account for 13.5% of the total portfolio value. All these are returns and risk in Lebanese pounds. This is the evolution of the oil share as the sample size increases from 24 months, 2 years, to approximately 360 months over the period 1987-2015. And as you see, the line is rather horizontal, which means the results are quite robust. The average oil share should be 6.8, the maximum 7.9, the minimum 5.3, the range is around 2.5%, and the 95% confidence interval for the oil share is between 6.6% and 7.07%. Again, these statistics show how much the oil share is stable, even if we vary the variance-covariance matrix from 2 months to more than 30 months. The risk in real term of these investments are for oil 30%, which is the highest, gold 12%, S&P 500 15%, euro 17%, a reposite in Lebanese pound, high variance and volatility of 25%, whereas the portfolio that I constructed has a risk of 8.3%, lower than the 5 assets altogether. What is my recommendation? Oil provides an annual realized return of 11.83%. Oil is a hedge against inflation, which averages 11.9%. Oil, if standalone, has the highest risk, double the standalone of the US stock market risk. Oil contributes to lowering the risk of the portfolio because of its low negative correlation with the other 4 assets. The position held in oil is always positive, averaging 6.8% of total portfolio value, and varies little with the size of the sample. Investors should be long in oil, i.e. invest positively in oil as an asset. Investors should buy oil futures on margin and buy call options on oil and roll forward the investment. That's my final recommendation. Thank you.